Breaking up is hard to do, even when it's with your financial advisor. Today on Talking Sense, we're tackling one of the more uncomfortable crossroads in your financial journey, breaking up with your well-meaning, but ultimately bad fit financial advisor. Whether you're ready to take control of your own financials, or you've just realized that maybe your advisor's approach just doesn't match yours. This is sometimes a difficult conversation to have, so we wanted to coach you guys through that and give you some tips. So I've brought Alec Darrell from our Conway office up here to join me on today's episode. So thank you so much for this. I know we've had some clients who we weren't the best fit for, and we've had some clients that maybe they weren't the best fit for us that we've helped move to someone that's a better fit. But one of the things that I find interesting is that a lot of people are worried about that conversation. I think they think maybe they're going to hurt our feelings or we're going to fight them. Maybe that's been their past experience. But there are times when it makes sense to just move on.
Yeah, that's definitely a tough conversation to have. I mean, it's like breaking up with a girlfriend in a sense. You're cutting someone off from your life who may or may not have provided value to you, but it can seem personal, whether it is or not. But you need to have someone who you want to see and that also they want to see you. And while you can take it personally, it isn't personal because at the end of the day, at least for us, we want you to have the best advisor for you.
Yeah, and we are going to talk through how to spot some red flags to know when it's time to move on, because sometimes it's just a personality thing or it's just a timing thing, but sometimes there are other reasons to step away. So we're going to talk about some of those. We're even going to give you a handy-dandy little breakup script. And most importantly, we're going to talk to you about how to set yourself up for success after the breakup. So think of this as a comprehensive guide to financial independence, minus the awkward, it's not you, it's me conversation. So as we dive into this, take some notes. Let's talk about this because we're going to start with reasons to move on. Let's talk about the most common ones. And the first one has to do with communication. So Alec, why don't you talk through that one?
Yeah, I think communication is everything. Making sure you have an advisor who lets you know that, hey, I hear you and I'm reaching out to you, giving you updates. I think that's really important. You don't really want to have just sporadic random updates. I think it's good for them to reach out, check in with you, see how you're doing, if anything has changed. And if the advisor isn't doing that, if they're not reaching out to you and seeing what's going on or letting you know what updates are happening, then it can kind of feel like you're just being left behind or they're not your advisor. So I think that's a really important aspect of it. Another one would be lack of fees and transparency with the fees.
I have had a number of clients who join our team that when we ask them, okay, what's your purpose of your investments? What's going on with these? They don't really know how their fees are set up. They don't know what they're paying and what they're paying for. And so we're not scared of fees. Listen, paying a fee is not a bad thing if you're getting financial advice. But if you're paying a fee and you're not getting any value for it, or you don't understand what that fee is, that's where the challenge is. So that's a common reason that people will leave an advisor as well. And the last one, which is probably the one that I feel like is the most important, is misaligned goals or beliefs. If your advisor is not really understanding your situation, like Alec talked about a moment ago, if they don't listen to you, they can't understand what you're trying to achieve. And if they don't know what you're trying to achieve truly, then they can't really help you. Or if their culture or if the way that they view investing does not align with your views, then that's something to consider too. We all have bias based on our experience, even as financial advisors. There are certain products that I am just not going to be a good fit for. So we've talked about this before. I'm not a stockbroker. I don't want to be a stockbroker. I don't want to be a day trader. So if you were looking for that type of advisor, I would be a bad fit because that misaligns with my culture as far as the way that I view investing. So just think about those things as kind of the common reasons. But let's talk about red flags. These are the things that, like, listen, if this resonates with you, don't hesitate. It's time to move on. Let's talk about identical investment mixes across all your different accounts. Now, I'm not saying that's always a bad thing, but if you notice that every single account has different goals but the same investments, that might be a red flag. So talking about diversification specifically, to be more blunt about it, okay? If your advisor is kind of like a one-trick pony where everything is the same, are they really looking out for your overall goals, or are they just pushing an easy button.
Another red flag would be having uninvested cash with no purpose behind that cash being in the account.
Mm-hmm.
If you look at this last year, we had a really good year in the market. And if you had a lot of cash and you didn't want a lot of cash, you didn't need that, that would really not be good because you missed out on a lot of gains. Mm-hmm. So if you went in for your annual review and you find out, hey, we had, $10,000 in cash that didn't grow with the market, and now you're investing it when the market's way higher, that would be very frustrating. Yeah, you missed a lot of opportunity.
And I've had situations in the past where a client had a cash balance because I couldn't get them to answer me. So if you're in that position and your advisor was reaching out and you're not responding, we can't invest without your help. You have to approve everything. So if you're the one that's not communicating, please, please, please reach out. But if they're not communicating, if they're not alerting you when there are cash balances, that is a reason to consider moving on. And then the last one that we consider to be a true red flag is high fees for basic investing strategies. I had a client, they were in an advisory type account. So this would be one where there's a portfolio that is supposed to be invested, but they had the wrong share class in there. And so the share class determines the fee of the individual investments. So it's supposed to be where they're only paying this management fee, but they were also paying higher investment fees. So there was this imbalance to the approach. I've also seen where someone has done a bunch of upfront sales charge type products, and then they're changing them consistently. And that doesn't make sense. Your strategy, the fees within it, have to align with the goals and purpose too. Again, we don't think fees in and of themselves are a bad thing, but they've got to have a purpose. So we've identified a few things here as far as red flags go. And I'd say another one we didn't really talk about here, we talked about it basically, but was the communication. If you have an advisor who, when you call, does not call you back, that's a problem. Now, being transparent, there are times like today while we're doing this recording, I have had back-to-back meetings. So I have not even been at my computer today, but I guarantee you those clients will get a call back tomorrow because that's what you have to do. We have people that are trusting us and relying on us, so that communication is critical.
Mm-hmm. Yeah, and not only not getting back to you over the phone, but also dodging questions in the meeting room. So dodging questions, especially about fees. Like if you ask, what's the fee on this account? And they just kind of go the other way. You want to know that stuff up front too. So while that is a common reason for moving on, it is also a red flag, just like communication.
Yeah, and I've had many clients express things like, not that these exact words are used, but hey, I know more than you, don't worry about it, I've got it. I've had clients who were spoken to that way by a financial advisor, and that one to me would make me crazy because our job is to educate and empower you to make wise choices. So if your advisor is not having those conversations to educate you about what you're doing, about what they're helping you accomplish, then that is definitely a red flag that we didn't talk about before, but it's certainly important. So let's talk about how to break up. So if you've decided you're going to shift to a new advisor and you have found somebody new, the first thing you need to do is get all of the accounts opened at the new provider's place of business. Now, we work with LPL Financial as our broker dealer. So if you are switching from us to another LPL provider, it would be a little bit different. But in most cases, you're moving from somewhere to a new broker, and you're going to need to open new accounts to be able to receive those assets. So that's step one. Next thing you can do is just send a brief professional notification to the advisor. And here's why it's important. Some broker dealers have products that need to be liquidated before you can shift them to the new place. And if you don't communicate with that advisor, they can't help facilitate that. Like I said, there's been some times where maybe I'm not the best fit for somebody, and where they're going can't hold what I've got here. That's very uncommon, but it can happen. And so in that case, I would certainly want to facilitate that, because if I'm not the best fit, I want to make sure you're making progress. So I'm going to help you with that transition. But if you don't let them know, they can't do that. Avoid detailed explanations in that. Keep it brief. Just, hey, I've decided I'm going to shift my accounts. You'll be getting a notification. Doesn't have to be fancy. Certainly not that it's not you, it's me approach.
Yeah, and for the next step, when you initiate the transfer, it may be a good idea to transfer those over in kind, whether that's avoiding fees or also possibly avoiding capital gains. If you have your fund over here, especially non-qualified funds, and you sell them, you may get hit with a big capital gain. So it may be in your best interest to keep it invested and move it over to the new firm and avoid having those capital gains taxes.
Yeah, and be aware of, transfer fees and, what the tax implications are, like you mentioned. It is normal for a provider to charge an account closing fee. There are a lot of documents that they'll have to file with the IRS to keep track of where the account went. They're going to have to produce some tax filings, even if you reinvest, if you're just transferring it. So it is normal for that. So just be aware of what those are and make sure you're understanding the impact to your overall balance. So, we talked about what to do to break up. Let's talk about what to do to set yourself up to win post breakup. First thing you need to do is make sure you have a way to access your current portfolio. So whatever you moved into, make sure you understand the asset allocation. Check for, what types of products they're putting in there. If we're adding to it again, they should be educating you about what they're purchasing. If they're making a change, it needs to be for a reason. We've had people who move their assets here and we make no changes initially or even at all, depending on the purpose of the investment. We've had clients who, they had a strategy that was working well, but the advisor just wasn't a good fit and it matches what we would have, basically been in here. So why subject them to new fees? We can shift it over and still manage it for them. But you do want to make sure you understand that. And if you had to liquidate anything at the old provider, you want to make sure that it gets reinvested when it arrives at the new one and doesn't stay in cash. So start by understanding where you're at. And then you've got to build a new strategy. And let's talk about what that looks like, Alec. When we're talking about creating a new strategy with a client, what do we do with them?
First, we want to figure out their goals and figure out what this money is for, and then figure out how we're going to invest it based on what it's for, and really just get a big financial picture from them. Figure out how their taxes are, what their long-term goals are, medium-term, short-term goals, and then we will invest based on all the information they give us and really just make sure that it aligns with everything that they want to do.
Yeah, because we've had people who they've had the same strategy for a long period of time, but their life has changed. So when we're shifting people, and if you're making a shift, it is important to do a new assessment of where you stand and make sure that you're on track for where you want to go. And then the last thing is to create simple financial routines. So if you had a direct deposit coming to make your contributions, a systematic contribution, you want to make sure you continue that at the new provider. So make sure that all of those things are in place. You want to calculate what your income is, make sure that you qualify to make those Roth contributions if that's what you were doing, and then establish a review schedule. Now, I will tell you, if you're a younger client, if you're a newer investor, you don't necessarily need to meet every year. Let's just be honest. At 25, it's not something that a lot of life change is happening where you need to be in their office every single year for a review. It could be a quick email. It could be a check-in. It could be a phone call. There's a lot of ways you can stay in connection and then reach out when life changes. Those are the times, job change, family change, dynamic changes, that you need to connect with your financial advisor. But I don't want you to feel like you have to meet every single year when you're in those busiest years of life. And even at my life stage, I'm not meeting every single year. I'm just getting together with my advisor about once every 2 years right now. So make sure you get into a good routine. Make sure you have clear communication with the new advisor about your expectations, because there's obviously a reason you've left the advisor you were with, and you want to make sure that your new advisor understands how you like to communicate, understands what goals weren't being met so they can make sure they're not missing the mark on anything, and they understand what expectations you have so that the relationship can be positive, just like a dating relationship, honestly. If we're honest about what we expect from each other, then we tend to have better relationships. So I don't know if I'm allowed to draw that parallel, but I'm going to. All right, it is time for our last 2 cents talking about this subject of breaking up with your financial advisor and helping yourself out with your next one. What are your final thoughts, Alec?
I think it's really important to just find the right advisor for you and make sure that they're aligned with your goals. You may have an advisor that you really like, but they're not going to help you get there. Same thing, vice versa. You may have an advisor who's going to get you there, but you really don't like. So I think finding one that has both is really important. But at the end of the day, every advisor is different. Every advisor is going to be better for someone, and they may not be better for someone else. So find the one that's best for you.
And I think that's why I love our team approach at GenWealth. There are things that I do really well, and there are things that I'm not as great at. And our team in Conway, which includes Alec and Chad, we all have different strengths that we can bring to the table for our clients. And so you kind of get almost, you get more heads in the room, more experiences, more training blended together to help you. That's why I love the teamwork approach that we use at Gen Wealth. So if you can't find that single person that meets your goals, maybe it's time to find the right team to support you on that journey. Well, we hope you guys have enjoyed this episode today. If you'd like to, you can get a free download on our website at getreadyforthefuture.com/keys. It is called 6 Keys to Unlocking Financial Independence. If you're a texter, you can text the word keys to 501-381-5228. Thank you for joining us this week on Talking Sense. If you like this episode, share it with a friend so they can have some help with, the breaking up that we sometimes have to do as well. Thanks for listening to Talking Sense. And if you like what you hear, make sure and subscribe to the podcast to get all the newest episodes. The Gen Wealth team is available to you 24/7 at info@getreadyforthefuture.com or by calling our offices at 866-653-PLAN. That's 866-653-7526. And while we like to have fun here, we're also financial advisors, and that means disclosures. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and Gen Wealth Financial Advisors are separate entities from LPL Financial.